Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on November 19th, 2016. So we've come now through the election. This particular week has been kind of a slow, grinding week to the upside. I think one thing you really have to keep in mind, kind of zooming out here in the S&P 500 in the broader market. All right, we are a stone's throw off of the all-time high. Now, is that a foregone conclusion? Absolutely not. But coming into the Thanksgiving kind of holiday week, just be reminded this Thanksgiving holiday week is going to have some lower liquidity, all right? Probably a little bit lower volatility as well. Nevertheless, we're going to be open on Monday, Tuesday, Wednesday, and of course, in terms of trading, Friday after Thanksgiving is a half a trading day, and that's just important to remind you. Don't get completely off guard on the Friday after Thanksgiving. It's a half trading day. Back when I first started in this industry, and even prior to that, I had family that traded, and the Friday after Thanksgiving was always like, bring family members to the floor kind of trading day. So some interesting memories from my childhood. The Chicago trading floor is no place to bring like a 6-year-old. Although it was extremely memorable. With that, one of the things that I'm getting emailed a tremendous amount about this past week happens to deal with not so much the market grinding higher over here, which there was, again, a lot of expectations of risk after the election. None of those really came to fruition. But many of us have now seen not only the rally, okay, and of course, you look at a rally like this, and as objective as you want to be, it's kind of hard to be objective when, every good piece of news could possibly be priced into a marketplace. And I remind you, I make no two ways about this. I am effectively short the market. But the questions I keep getting are in reference to the VIX. And everybody's seen that the VIX, spiked into the election, but it's backed off a tremendous amount. And the questions I'm always getting are, revolving around, can we get into some type of a volatility spread at this point? Like, I want to go out and I want to buy the VIX, or, I want to buy the VXX or the UVXY. First and foremost, the UVXY, the VXX, those are not products that you want to go out and buy the physical underlying ETFs. Okay, they have a tremendous drag rate. If you've looked at the VIX, great. Okay, if you haven't looked at the VXX, well, this product, they literally keep reverse splitting it. Ultimately, to keep it in business, you have to reverse split it. And it's, decaying almost like an option at this point. But if you take a look at the volume, it traded, some almost 35 million shares last Friday. You open it up, and there's only 45 million shares left in the float. And that's what happens when you reverse split a product. What a reverse split ultimately means is, it's right now, again, like a $29 product. If it were to reverse split 2 for 1, it would jump to a $60 product. But I don't think you guys realize they just reverse split it yet again. And, sometimes they do 4 for 1s on here, but the same thing is true of the UVXY. These are highly flawed products. Okay, and this is another one that they reverse split time and again. This is just a 9-month chart going from 233 down to 11. So even if you're trading options, you have to be aware of the huge drag rate. So rather than have this, long debate about the VXX and the UVXY, we're going to take a look at VIX options during this kind of weekend update, because I think there is a definitive trade idea and opportunity in some of the VIX options. But the VIX options, okay, I want to make this clear in no uncertain terms. The VIX options, to me, it's one, of the most convoluted products to discuss. And that's what most people don't really realize. They're like, oh, why is it such a convoluted topic of conversation? Well, because the VIX options have absolutely nothing to do with the VIX itself. All right, there's, a little bit to do with the VIX, but really the VIX options themselves, they're not priced from the VIX. So when you open up like these December VIX options, okay, they're not being priced off of the VIX. The December VIX options happen to be, in fact, priced off of the Volatility Futures. So you get tens of thousands of retail clients that are trading VIX options, and they're all looking at the VIX like, it's at 12, right? And if you look back over here, well, it's not rock bottom, but come on, it's getting down there. Like, you know, in recent memory, it hasn't been much lower. You bring up like a, let's look at a 3-year weekly. Yeah, it doesn't get much lower than this, you know. Hey, the beginning of the year. I mean, when you look at the, you know, the presidential election and everything, and you realize the president-elect, they haven't, you know, faltered on one area, the slightest mishap, and the volatility could get spiking over there. We should only be so lucky, right? The slightest mishap, by the way, it's not about being bullish or bearish. It's about being extremely bearish from where I stand. However, when you take a look at the VIX, you know, well, the VIX options, that's not what you're trading. You're not trading the VIX. You're actually trading these volatility futures. And that's, I want to present an opportunity to you, but you have to understand the product. First of all, the December volatility futures are displaying right here, and I'll kind of highlight this a little bit on the screen, but right in this neighborhood right there, that is a $15, again, a $15 product. But then if you take a look out a little bit further in time, and now we're going to go out, I say a little further in time, we could even consider doing a January trade. Well, here's the January volatility futures, which are trading somewhere around 16, we'll call it 70. All right, so keep this in mind that the January volatility futures are trading roughly at 1670 over there. So if you're going to price VIX, and you're going to price the VIX in Jan, all right, so the VIX in Jan is equivalent to 1670. That's what the options are pricing. Now, let's go ahead and show you that. So let's go back over to the VIX product itself, and we'll open up the January options, because I think going out to December right now, listen, there's a lot of holiday, yada, yada, yada. If we're going to do a trade, you know, in the volatility product, let's do it out in January, give ourselves a little bit more time. You know, again, when you're buying volatility, you need to give yourself some time for the world to fall apart, because that's what it is. When you're buying volatility, you're like, I hope that the world falls apart. Come on, admitting it's the first step. You know, that's why I yada yada'd over the best part over there. It's, you know, again, you're rooting for volatility, you're rooting for the world to come apart at the seams. It's okay to do that. Anyway, when you look at the January options, and there's 59 days, okay, you can't look over here. When I say over here, like these 13.5 calls, okay, because these options, they're actually deep in the money. As I said, if you look at the VIX itself, again, these options here in January, and I want to kind of elaborate again, these January options right there, they are not based, and I'm going to cross it out, they're not based on the last price of the VIX. Okay? They're actually based on the volatility futures. Now, there's another neat way to figure this out. If you look at the deep in the money calls, these 10 calls right here, and again, everything on this side of the screen is calls. Everything on this side of the screen, of course, is the puts. But if you're taking a look at the calls, and the deep in the money calls right there, and you see the market is basically 660 at 680. Add the mid price, which is roughly 670, to 10, which is the in the money, all right, strike. So what you get is approximately what? All right, some higher math over here. For the most part, comes out to about 1670. So the in-the-money calls are telling you where the volatility product that you're trading truly is. So you don't have to keep going over the volatility futures. Just look at the deep-in-the-money calls that come out to about 1670, right? So now you realize that the product is really trading almost in this neighborhood. Okay, almost in this neighborhood, almost at 17, which kind of makes sense. Like I put delta up here, and you can see the deltas out here are like, you know, 0.60, 0.53. 0.53 delta is roughly the at-the-money option. Now, what can I do then if I wanted to buy volatility? Well, if you want to buy volatility, you can do, you know, well, many of the trades that we do continuously. This is not something like, again, the VIX product can be highly volatile. I mean, you're trading a 77% implied volatility product. And most people trade stuff like Apple or Google. You know what the implied volatility in Apple or Google is? Come on, it's like 20%, right? Cruise over to Apple, it's like a 20% vol. Over here, you got 77, vol. You don't want to just go out and buy a call because that call is going to be rich in premium. So you look towards, the same simplicity and the same types of trades that we always do. Do stuff like in-out spreads. So here is a $2 wide spread that you're buying for like a 60-cent debit. But when I'm looking for in-out spreads, I'm willing to pay a little bit more than like 60 cents. All right, so in this particular case, you kind of play around with it a bit, but you can go out and like buy the 15s, okay, and for instance, like sell the 17s. Again, a $2 wide spread trading for about a 75-cent debit. Now, if you look at this spread, you kind of think to yourself, oh man, I mean, the VIX has got to go from what? 1285, and it's got to shoot all the way up to like 17. Excuse me. No, it doesn't. The VIX doesn't have to go from 12 above 17. I told you, you're not trading the VIX. You're trading the volatility future. And the volatility future is already trading at what? Okay? That's why this is important. That's why, this conversation has to happen over here. This volatility product is already trading roughly, okay, at 1670. It does have to spike. The volatility, future is probably going to have to go up a few points for this spread down here to become profitable. So you get all these clientele of TheoTrade and from all walks of life, and they're getting involved in these volatility products without really knowing definitively what they're trading. Again, if you think that the VIX is convoluted, then people go, well, Don, just make it easier. Why don't you just go trade the VXX? Because the VXX is also a highly flawed product, not dissimilar at all, okay, to how the VIX options trade. Just be aware, again, of the product that you're trading. Look at the opportunity here. It's, in the next 59 days, if volatility goes up, you're not going to make windfall profitability on this trade. Listen, this is a $2 wide spread, right? The most you can make on a $2 wide spread is $2. But you already paid 75 cents up front. So the most you can make is $1.25. And frankly speaking, I don't even want you to make $1.25. Go out there and make, 50, 60, 70% on one of these spreads. You're golden. This business right now, this is not about hitting, a home run out of the ballpark. This is about going out, picking up a couple nickels and dimes in front of a very efficient bulldozer. And you have to really respect the fact that volatility collapsed a lot. We think there's a great opportunity in volatility, especially 59 days out. However, I think you have to take the right position. You don't want to go out there and just buy a call because the decay is going to absolutely hammer you day in and day out. Be efficient, use a spread, get out of the way, get hedged, buy some volatility, and see how we run for the next 59 days. Thanks everybody for joining us here at TheoTrade on the Weekend Update. I am Don Kaufman. I'll be with you all this week on TheoTrade Chat. Have a great weekend. Bye-bye.